Question 1. What is the primary difference between proportional and non-proportional reinsurance? A proportional reinsurance involves a fixed percentage of the original premium being transferred, while non-proportional reinsurance involves a fixed premium amount. B. Proportional reinsurance transfers a fixed percentage of the risk, while non-proportional reinsurance only transfers losses that exceed a certain amount. C. Proportional reinsurance transfers a fixed amount of risk, while non-proportional reinsurance transfers the risk. D. Proportional reinsurance applies to facultative reinsurance only, while non-proportional reinsurance applies to treaty reinsurance only. Answer: B. Proportional reinsurance transfers a fixed percentage of the risk, while non-proportional reinsurance only transfers losses that exceed a certain amount. Explanation: proportional reinsurance involves the transfer of a specified percentage of both premiums and risks between the insurer and the reinsurer. The reinsurer participates in a fixed portion of both the premiums and claims for the policies underwritten by the ceding company. Non-proportional reinsurance, on the other hand, is based on excess risk, meaning the reinsurer only becomes liable for losses that exceed a certain retention limit or threshold. The key difference is how the risk is shared and when the reinsurer is called into action. Proportional contracts like quota share or surplus share involve the proportional sharing of the risk and premiums. Non-proportional contracts, such as excessive loss or stop loss, come effect only when losses exceed a predetermined amount. Question 2. Mr. Adams is the claims manager for a company that has a reinsurance treaty with a reinsurer. The company has just reported a large loss from a natural disaster, and the reinsurer is questioning the validity of the claim. What should Mr. Adams do to resolve the situation? A. Immediately accept the reinsurer's decision to reject the claim. B. Gather all the necessary documentation and evidence related to the loss and follow the claims reporting and dispute resolution procedures outlined in the reinsurance contract. C. Request that the reinsurance contract be amended to cover the specific loss event in question. D. File lawsuit against the reinsurer for breach of contract. Answer: B. Gather all the necessary documentation and evidence related to the loss and follow the claims reporting and dispute resolution procedures outlined in the reinsurance contract. Explanation: when there is a dispute over the validity of a reinsurance claim, the first course of action should be to gather all relevant documentation such as loss reports, correspondence, and any other supporting evidence. This will help substantiate the claim. Reinsurer: the claims manager must then follow the dispute resolution process specified in the reinsurance contract, which may involve internal reviews or arbitration. Option A is incorrect because the claims manager should not immediately accept the reinsurer's decision without verifying the claim's validity. Option C is incorrect because modifying a reinsurance contract mid-claim is not standard practice unless both parties agree and a valid reason exists. Option D is too aggressive. Litigation should only be pursued if the dispute cannot be resolved through contractual dispute resolution methods. Question 3. Which of the following is the primary role of the retention limit in a reinsurance contract? A. It determines the amount of risk the reinsurer is willing to accept before any claims payments are made. B. It establishes the maximum amount the ceding insurer will pay out on claims before the reinsurance contract kicks in. C. It sets the level at which the reinsurer will begin to pay losses after the ceding insurer has exceeded the agreed retention. D. It is the fixed amount of premium the ceding insurer pays to the reinsurer to initiate reinsurance agreement. Answer: C. It sets the level at which the reinsurer will begin to pay losses after the ceding insurer has exceeded the agreed retention. Explanation: the retention limit in a reinsurance contract refers to the amount of risk the ceding insurer retains before the reinsurer becomes liable. It is essentially the threshold above which the reinsurer starts covering losses. The ceding insurer is responsible for any losses up to the retention amount. Reinsurer covers losses that exceed this limit. Retention limits are important in both proportional and non-proportional reinsurance agreements. Option A is incorrect because the retention limit does not define the reinsurer's willingness to accept risk, but rather the point at which the reinsurer starts paying claims. Option B is incorrect because it inaccurately describes the role of the retention limit. It is not about the insurer's maximum payout, but the threshold for reinsurer involvement. Option D is incorrect as the retention limit pertains to losses, not premiums, and is part of the claim structure. Question 4. Which of the following is a key benefit of using excessive loss reinsurance? A. It allows the ceding insurer to share a fixed portion of both premiums and claims. B. It provides coverage for losses exceeding a predetermined retention level, thereby limiting the insurer's exposure to large losses. C. It ensures that the reinsurer participates in every claim, regardless of the size. D. It helps the ceding insurer avoid regulatory reporting requirements. Answer: B. It provides coverage for losses exceeding a predetermined retention level, thereby limiting the insurer's exposure to large losses. Explanation: excessive loss reinsurance is a form of non-proportional reinsurance where the reinsurer covers losses that exceed a specified retention limit or threshold. This allows the ceding insurer to manage large or catastrophic losses, which would otherwise significantly impact its financial stability. Reinsurer only covers losses above the retention, providing the ceding insurer with a safety net for extreme events. Option A is incorrect because proportional reinsurance, not excessive loss, involves sharing both premiums and claims in fixed percentages. Option C is incorrect because excessive loss reinsurance is triggered only by losses that exceed a specific threshold, not by every claim. Option D is incorrect as the use of excessive loss reinsurance does not exempt the ceding insurer from regulatory reporting. It may still be required. Question 5. Which clause in a reinsurance contract specifies the conditions under which the reinsurer is required to make payment for losses? A. Loss occurrence clause. B. Retention clause. C. Arbitration clause. D. Reinstatement clause. Answer: A. Loss occurrence clause. Explanation: the loss occurrence clause is a key provision in reinsurance contracts that specifies the conditions under which the reinsurer becomes liable to make payments for losses. This clause outlines the circumstances in which a loss is deemed to have occurred and how it should be reported to the reinsurer. It also typically defines what constitutes a single loss and any relevant timeframes for loss occurrences. Option B is incorrect as the retention clause defines the amount of risk the ceding insurer retains before the reinsurer's involvement. Option C is incorrect because the arbitration clause addresses the resolution of disputes, not the payment conditions for losses. Option D is incorrect as the reinstatement clause deals with the reinstatement of coverage limits after loss has been paid, not the payment conditions themselves. Question 6. Mr. Bennett works for an insurance company that is negotiating a treaty reinsurance agreement. What is one of the primary advantages of entering into a treaty reinsurance contract rather than facultative reinsurance? A. Treaty reinsurance allows the insurer to individually negotiate terms for each policy covered. B. Facultative reinsurance involves automatic coverage for every policy written by the insurer. C. Treaty reinsurance provides automatic coverage for all risks within the scope of the treaty without requiring individual negotiations. D. Facultative reinsurance offers broader coverage limits than treaty reinsurance. Answer: C. Treaty reinsurance provides automatic coverage for all risks within the scope of the treaty without requiring individual negotiations. Explanation: treaty reinsurance provides automatic coverage for all risks that fall within the terms of the agreement without requiring individual negotiations for each policy or risk. Once the treaty is in place, it covers a predefined class of business, such as all policies of type A meets the conditions of the treaty. This is contrasted with facultative reinsurance, where each individual risk is reviewed and negotiated on a case-by-case basis. Treaty reinsurance offers the benefit of efficiency and broad coverage for many policies at once. Option A is incorrect because individual policy negotiations are a feature of facultative reinsurance, not treaty reinsurance. Option B is incorrect because facultative reinsurance does not provide automatic coverage for all policies. Each risk must be individually accepted. Option D is incorrect as facultative reinsurance typically does not offer broader coverage limits than treaty reinsurance. It is more about individual risk selection. Question 7. Which of the following is the most accurate description of the role of reinsurance in managing catastrophic risk? A. Reinsurance transfers the responsibility for all claims from the ceding insurer to the reinsurer. B. Reinsurance helps the ceding insurer spread its risk, especially in cases of extreme events such as natural disasters. C. Reinsurance guarantees that the ceding insurer will receive full compensation for all losses. D. Reinsurance is primarily used to improve the insurer's marketing and client relationships. Answer: B. Reinsurance helps the ceding insurer spread its risk, especially in cases of extreme events such as natural disasters. Explanation: reinsurance is used to manage catastrophic risk by transferring a portion of the insurer's risk to reinsurer. This is particularly important when the insurer faces potential large-scale losses, such as those caused by natural disasters, e.g., earthquakes, hurricanes. By using reinsurance, the insurer can protect itself against financial ruin from these events by sharing the burden of such large claims. Option A is incorrect because reinsurance does not transfer all claims responsibility. The ceding insurer retains some level of risk, particularly in proportional reinsurance. Option C is incorrect because reinsurance does not guarantee full compensation for all losses. The reinsurer's liability is subject to the terms of the contract. Option D is incorrect because reinsurance's primary function is risk management, not marketing or client relations. Question 8. In a facultative reinsurance contract, which of the following is the primary responsibility of the ceding insurer? A. To automatically cede a fixed percentage of all risks to the reinsurer. B. To individually negotiate terms for each risk and offer them to the reinsurer. C. To accept all reinsurance offers from the reinsurer. D. To provide coverage for all catastrophic losses without involving the reinsurer. Answer: B. To individually negotiate terms for each risk and offer them to the reinsurer. Explanation: in facultative reinsurance, the ceding insurer has the responsibility to negotiate the terms of coverage for each individual risk and offer it to the reinsurer for acceptance. The reinsurer then has the option to accept or reject each risk, which provides flexibility but also requires more administrative effort. Option A is incorrect as facultative reinsurance does not automatically involve a fixed percentage of risk transfer. Each risk is negotiated individually. Option C is incorrect because the reinsurer has the right to accept or decline individual risks in facultative reinsurance. Option D is incorrect because the ceding insurer typically retains a portion of the catastrophic losses and reinsurance is used to limit the financial impact of such losses. Question 9. What is the purpose of a reinstatement clause in a reinsurance contract? A. It allows the reinsurer to cancel the contract after a claim is made. B. It defines how coverage is reinstated after a claim has been paid and the retention limit has been exhausted. C. It ensures that premiums are refunded after a claim is paid. D. It allows the ceding insurer to modify the terms of the contract if it disagrees with a claims decision. Answer: B. It defines how coverage is reinstated after a claim has been paid and the retention limit has been exhausted. Explanation: the reinstatement clause is a provision in a reinsurance contract that outlines the process for reinstating coverage after a claim is paid and the limit of the reinsurance protection has been exhausted. This clause is particularly important in excessive loss reinsurance as it ensures that the reinsurer's coverage limit is restored after significant claim so that the ceding insurer can continue to rely on the reinsurance for subsequent claims. Option A is incorrect because the reinstatement clause does not give the reinsurer the right to cancel the contract. Option C is incorrect as the reinstatement clause does not involve premium refunds but focuses on the restoration of coverage limits. Option D is incorrect because the reinstatement clause pertains to coverage limits, not contractual amendments based on disagreements about claims. Question 10. What is the primary function of retrocession in reinsurance? A. To transfer the entire risk from the ceding insurer to a reinsurer. B. To allow the reinsurer to transfer part of the risk they have assumed to another reinsurer. C. To protect the reinsurer from the financial insolvency of the ceding insurer. D. To distribute the risk of catastrophic losses equally among all reinsurers. Answer: B. To allow the reinsurer to transfer part of the risk they have assumed to another reinsurer. Explanation: retrocession is a process in which a reinsurer, after assuming risk from the ceding insurer, then transfers some of that risk to another reinsurer, known as a retrocessionaire. This is done to manage the reinsurer's own exposure to large losses and to balance their risk portfolio. Option A is incorrect because retrocession does not involve the ceding insurer transferring all risk. It involves reinsurers transferring risk among themselves. Option C is incorrect as retrocession addresses the reinsurer's risk management, not the ceding insurer's financial solvency. Option D is incorrect because retrocession is not designed to distribute losses equally among all reinsurers. Rather, it is a way for reinsurer to manage its own exposure. Question 11. Which of the following best describes the concept of loss creep in reinsurance? A. The gradual increase in the number of claims under a reinsurance contract over time. B. The increase in the severity of claims over time after a loss has been reported. C. The decrease in the total number of claims over time as the insurer's risk is mitigated. D. The gradual decline in the reinsurer's risk exposure as claims are paid. Answer B. The increase in the severity of claims over time after a loss has been reported. Explanation: loss creep refers to the situation where the severity or cost of claims increases over time even after the initial claim has been reported. This often occurs when the full extent of the damages or the scope of claims is not fully understood at the outset, leading to higher than expected losses as more information becomes available. Option A is incorrect, as loss creep pertains to the severity of claims, not the frequency. Option C is incorrect because loss creep involves an increase in claims severity, not a decrease in the number of claims. Option D is incorrect, as loss creep refers to an increase in claims severity, not a decrease in exposure. Question 12. Which type of reinsurance is typically used to protect an insurer from unusually large losses resulting from a single event? A. Facultative reinsurance. B. Treaty reinsurance. C. Excessive loss reinsurance. D. Proportional reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is designed to protect the ceding insurer from catastrophic losses resulting from a single event, e.g., a natural disaster or large claim, by covering losses that exceed a predefined retention limit. This type of reinsurance helps mitigate the financial impact of large and frequent losses. Option A is incorrect because facultative reinsurance is used on a case-by-case basis, not specifically for catastrophic events. Option B is incorrect because treaty reinsurance typically covers a broader range of risks, not just large losses from a single event. Option D is incorrect, as proportional reinsurance involves sharing premiums and losses on a fixed percentage basis, rather than protecting against extreme losses. Question 13. In which of the following scenarios would a ceding insurer most likely use of surplus share reinsurance arrangements? A. When the insurer needs to manage large unexpected losses from a single event. B. When the insurer wants to share a portion of its premiums and losses on a proportional basis with the reinsurer. C. When the insurer wants to limit its risk exposure for individual risks that exceed its underwriting capacity. D. When the insurer is unable to manage catastrophic losses and needs to rely on excessive loss reinsurance. Answer: C. When the insurer wants to limit its risk exposure for individual risks that exceed its underwriting capacity. Explanation: surplus share reinsurance is a form of proportional reinsurance where the reinsurer assumes a portion of the insurer's risk on individual policies that exceed the ceding insurer's retention limit. This allows the ceding insurer to limit its exposure to individual large risks that it is unable to handle on it. Option A is incorrect because excessive loss reinsurance is more appropriate for managing large unexpected losses from a single event. Option B is incorrect, as surplus share is specifically for limiting exposure on larger individual risks, not for sharing premiums and losses proportionally on all risks. Option D is incorrect because excessive loss reinsurance would be used to manage catastrophic losses, not surplus share. Question 14. Which type of reinsurance arrangement would most likely be used by an insurer to achieve greater diversification of its risk portfolio across multiple lines of business? A. Excessive loss reinsurance. B. Facultative reinsurance. C. Treaty reinsurance. D. Surplus share reinsurance. Answer: C. Treaty reinsurance. Explanation: treaty reinsurance is a long-term automatic reinsurance arrangement that provides coverage across a range of business lines as specified in the treaty. This type of reinsurance allows the ceding insurer to automatically share risk with the reinsurer without the need for individual negotiations, helping the insurer achieve broader risk diversification. Option A is incorrect because excessive loss reinsurance is typically used for large individual risks or catastrophic events, not for diversification. Option B is incorrect because facultative reinsurance is used for individual risks, not for broader diversification. Option D is incorrect because surplus share reinsurance is more focused on individual policies rather than achieving broad portfolio diversification. Question 15. Which of the following statements accurately describes a key difference between proportional and non-proportional reinsurance? A. Proportional reinsurance involves the reinsurer sharing both premiums and claims, while non-proportional reinsurance only shares claims. B. Proportional reinsurance covers only catastrophic losses, while non-proportional reinsurance covers all types of losses. C. Proportional reinsurance is based on a fixed amount of coverage per risk, while non-proportional reinsurance is based on the amount of loss exceeding a specified retention. D. Proportional reinsurance involves excess coverage, while non-proportional reinsurance involves sharing a percentage of each claim. Answer: C. Proportional reinsurance is based on a fixed amount of coverage per risk, while non-proportional reinsurance is based on the amount of loss exceeding a specified retention. Explanation: Proportional reinsurance involves the reinsurer and ceding insurer sharing a fixed percentage of premiums and claims for each risk covered. Non-proportional reinsurance, on the other hand, is triggered when losses exceed a certain retention level. Reinsurer only covers the amount above that threshold. Option A is incorrect, as non-proportional reinsurance also shares premiums, but not in a fixed percentage of each risk. Option B is incorrect because both types of reinsurance can cover a wide range of losses, not just catastrophic ones. Option D is incorrect, as excess coverage is a feature of non-proportional reinsurance, not proportional reinsurance. Question 16. Which of the following is a potential disadvantage of using facultative reinsurance? A. It does not provide a way to manage large catastrophic losses. B. It requires the ceding insurer to individually negotiate each risk with the reinsurer. C. It automatically covers all policies under a treaty. D. It is primarily used for managing the reinsurer's exposure to catastrophic risks. Answer: B. It requires the ceding insurer to individually negotiate each risk with the reinsurer. Explanation: a disadvantage of facultative reinsurance is that it requires the ceding insurer to negotiate each individual risk separately with the reinsurer, which can be time-consuming and administratively expensive. This is in contrast to treaty reinsurance, which provides automatic coverage for all risks within the scope of the treaty. Option A is incorrect because facultative reinsurance can be used for managing both large and smaller risks, not just catastrophic losses. Option C is incorrect because facultative reinsurance does not automatically cover all policies. Each risk must be negotiated. Option D is incorrect because facultative reinsurance is used for individual risks, not specifically for catastrophic risks. Question 17. In a reinsurance contract, what is the purpose of the claims made trigger? A. It defines the date when the reinsurance contract begins to cover losses. B. It specifies when claims must be made for them to be eligible for reinsurance coverage. C. It determines the maximum amount of coverage the reinsurer will provide. D. It allows the ceding insurer to choose which claims will be covered under the contract. Answer: B. It specifies when claims must be made for them to be eligible for reinsurance coverage. Explanation: the claims made trigger specifies that coverage is available only for claims that are reported during the policy period or within a specified period after the policy expires. This is a common feature in liability insurance, ensuring that only claims made during the coverage period are eligible for reimbursement. Option A is incorrect, as the trigger is related to the timing of claims, not the start date of the contract. Option C is incorrect, as the claims made trigger does not define coverage limits. It defines when claims must be reported. Option D is incorrect because the claims made trigger is about timing, not about choosing which claims are covered. Question 18. Which of the following is the primary benefit of using proportional reinsurance for an insurer? A. It helps the insurer mitigate the risk of catastrophic losses by covering specific events. B. It allows the insurer to share both premiums and losses with the reinsurer on a fixed percentage basis. C. It provides the insurer with protection against losses above a certain threshold. D. It reduces the insurer's need to buy excess coverage for large losses. Answer: B. It allows the insurer to share both premiums and losses with the reinsurer on a fixed percentage basis. Explanation: proportional reinsurance allows the insurer to share both premiums and losses with the reinsurer on a fixed percentage basis. This type of reinsurance helps the ceding insurer manage its exposure by sharing the financial impact of losses with the reinsurer in proportion to the premiums it receives. Option A is incorrect, as proportional reinsurance covers a broad range of risks, not just specific events. Option C is incorrect, as excessive loss reinsurance is the form used to provide protection against large losses exceeding the threshold. Option D is incorrect because proportional reinsurance does not replace excess coverage but instead shares risk on a proportional basis. Question 19. What is the main purpose of quotas in proportional reinsurance contracts? A. To limit the amount of risk the reinsurer assumes on any given policy. B. To establish a fixed amount of premiums to be paid to the reinsurer. C. To determine the number of policies the insurer must cede to the reinsurer. D. To allocate losses between the insurer and reinsurer based on a fixed percentage. Answer: D. To allocate losses between the insurer and reinsurer based on a fixed percentage. Explanation: in proportional reinsurance, quotas refer to the fixed percentage of premiums and losses that the ceding insurer and the reinsurer will share. This is agreed upon when the contract is written, and it ensures that the reinsurer shares both the premiums and the risk in proportion to that percentage. Option A is incorrect because quotas refer to allocation, not a cap on the reinsurer's risk. Option B is incorrect as quotas involve the sharing of premiums and losses, not setting premium amount. Option C is incorrect as quotas do not limit the number of policies ceded but rather the proportion of premiums and losses. Question 20. In the context of reinsurance, what does the term retention refer to? A. The portion of premiums retained by the reinsurer. B. The amount of risk an insurer retains before it passes risk to a reinsurer. C. The share of losses a reinsurer agrees to cover in a proportional arrangement. D. The maximum amount an insurer can cede to the reinsurer in a treaty. Answer: B. The amount of risk an insurer retains before it passes risk to a reinsurer. Explanation: retention refers to the portion of the risk that the ceding insurer keeps for itself before transferring any excess risk to the reinsurer. It is the insurer's responsibility, which can be set dollar amount or percentage of the loss. Option A is incorrect as retention involves the insurer, not the reinsurer. Option C is incorrect because retention refers to the insurer's portion, not the reinsurer's share of losses. Option D is incorrect because retention defines the risk the insurer keeps, not the maximum ceded amount. Question 21. Which of the following is a key characteristic of a stop-loss reinsurance arrangement? A. It allows the reinsurer to pay for losses that exceed a set amount, but only after the insurer has exhausted its retention limit. B. It involves the reinsurer paying a fixed percentage of each loss up to a maximum amount. C. It automatically covers all risks under an insurance policy, regardless of the loss amount. D. It is used to cover only losses that arise from catastrophic events. Answer: A. It allows the reinsurer to pay for losses that exceed a set amount, but only after the insurer has exhausted its retention limit. Explanation: stop-loss reinsurance protects the ceding insurer from excessive losses by reimbursing the insurer. Once losses exceed a certain threshold or retention limit, the reinsurer steps in when the insurer's losses surpass the retention level. Option B is incorrect because stop-loss does not pay a fixed percentage it activates after retention level is exceeded. Option C is incorrect as stop-loss coverage is triggered based on the insurer's losses exceeding a set limit. Option D is incorrect as stop-loss can apply to a range of losses, not just catastrophic events. Question 22. Which of the following best describes a catastrophe reinsurance? A. Reinsurance that provides coverage for all types of small, frequent claims. B. Reinsurance that provides protection for losses exceeding a set retention limit due to catastrophic events. C. Reinsurance that covers policyholder liabilities in the event of mass claims. D. Reinsurance that allows the ceding insurer to share large claims equally with the reinsurer. Answer: B. Reinsurance that provides protection for losses exceeding a set retention limit due to catastrophic events. Explanation: catastrophe reinsurance is designed to cover the ceding insurer from large unexpected losses resulting from catastrophic events like natural disasters. This form of reinsurance typically involves excessive loss or stop-loss arrangements to cover claims exceeding a retention limit. Option A is incorrect as catastrophe reinsurance is intended for large catastrophic losses, not small, frequent claims. Option C is incorrect because catastrophe reinsurance specifically addresses large-scale events, not just mass claims. Option D is incorrect because the coverage is for extreme losses, not for equal sharing of large claims. Question 23. Which of the following is not typically covered by reinsurance? A. Losses from natural disasters. B. Risks related to policyholder mortality. C. Operating expenses of the ceding insurer. D. Claims from policyholders' lawsuits. Answer: C. Operating expenses of the ceding insurer. Explanation: reinsurance generally covers losses resulting from specific insured events like natural disasters, mortality, or legal claims. However, it does not cover the operating expenses of the ceding insurer as it focuses on indemnifying the insurer for losses. Option A is incorrect because natural disasters are typically covered under reinsurance policies, especially catastrophe reinsurance. Option B is incorrect as mortality risk, especially in life insurance, is often covered by reinsurance. Option D is incorrect because reinsurance can cover liability-related claims, such as those arising from lawsuits. Question 24. Which of the following is a common use of facultative reinsurance? A. To automatically cover all policies within an insurer's portfolio. B. To provide coverage for specific policy or group of policies based on individual risk assessment. C. To limit an insurer's exposure by sharing fixed percentage of all premiums. D. To allow the reinsurer to automatically receive share of every premium the ceding insurer receives. Answer: B. To provide coverage for a specific policy or group of policies based on individual risk assessment. Explanation: facultative reinsurance is used for individual risks that are assessed and negotiated one by one, rather than automatically covering entire portfolios. This form of reinsurance is typically used when specific risks need specialized coverage. Option A is incorrect as facultative reinsurance is not automatic. It applies to individual risks. Option C is incorrect because facultative reinsurance does not involve sharing premiums based on a fixed percentage for all risks. Option D is incorrect because facultative reinsurance involves specific risks, not automatic sharing of premiums. Question 25. In the context of reinsurance, what does the term ceding commission refer to? A. A fee the reinsurer pays to the ceding insurer to cover its operating costs. B. The portion of premiums ceded to the reinsurer under a proportional reinsurance agreement. C. The portion of reinsurance premiums returned to the ceding insurer as a rebate. D. A percentage of losses paid by the reinsurer under excessive loss reinsurance agreements. Answer: A. A fee the reinsurer pays to the ceding insurer to cover its operating costs. Explanation: the ceding commission is a fee paid by the reinsurer to the ceding insurer to cover the latter's administrative expenses and the cost of acquiring and managing business under a reinsurance agreement. It is typically included in proportional reinsurance agreements. Option B is incorrect because ceding commission is not the portion of premium ceded to the reinsurer but a separate payment made to the ceding insurer. Option C is incorrect as ceding commissions are not rebates but compensation for administrative expenses. Option D is incorrect as it refers to loss payments, not administrative expenses. Question 26. What is the primary goal of non-proportional reinsurance? A. To ensure the reinsurer shares an equal portion of the premiums and losses. B. To provide protection for the ceding insurer against losses that exceed a certain threshold. C. To automatically cover all risks under the reinsurance contract. D. To share the underwriting expenses between the ceding insurer and reinsurer. Answer: B. To provide protection for the ceding insurer against losses that exceed a certain threshold. Explanation: non-proportional reinsurance protects the ceding insurer from large losses by reimbursing the insurer only after the loss exceeds a predetermined threshold. Retention: it is typically used for catastrophic events. Option A is incorrect because non-proportional reinsurance does not involve sharing losses equally. It only covers losses exceeding a threshold. Option C is incorrect as non-proportional reinsurance does not automatically cover all risks, just large ones that exceed the retention. Option D is incorrect as non-proportional reinsurance focuses on covering large losses, not underwriting expenses. Question 27. Which of the following is an example of excessive loss for reinsurance? A. The reinsurer agrees to pay 50% of losses above the specified retention amount. B. The reinsurer pays a percentage of every claim regardless of size. C. The reinsurer covers all losses under a specified retention level. D. The reinsurer covers losses only for specific catastrophic events. Answer: A. The reinsurer agrees to pay 50% of losses above a specified retention amount. Explanation: excessive loss reinsurance is structured to cover only losses that exceed a specified retention amount. Typically for individual or catastrophic events, the reinsurer will pay a percentage or the full amount of losses that surpass this threshold. Option B is incorrect as excessive loss does not pay a percentage of every claim. Option C is incorrect because excessive loss is triggered only when losses exceed a retention limit. Option D is incorrect because excessive loss can cover a range of large losses, not just catastrophic events. Question 28. In reinsurance, what is meant by the term surplus share in a proportional reinsurance arrangement? A. The reinsurer takes on all losses above a specified retention level. B. The reinsurer assumes a portion of the premiums and losses for policies exceeding a certain amount. C. The reinsurer pays a fixed amount of premiums to the ceding insurer for each policy written. D. The ceding insurer shares a portion of its claims with the reinsurer on a per policy basis. Answer B. The reinsurer assumes a portion of the premiums and losses for policies exceeding a certain amount. Explanation: in surplus share reinsurance, the reinsurer agrees to assume a portion of the premiums and losses for policies that exceed a certain amount of insurance, known as the retention limit. This allows the ceding insurer to limit its exposure to larger policies while the reinsurer takes on part of the risk. Option A is incorrect as it describes excessive loss reinsurance, not surplus share. Option C is incorrect because the reinsurer does not pay a fixed amount per policy. It takes a share of losses and premiums for policies over the retention limit. Option D is incorrect as it suggests the ceding insurer shares claims, but in surplus share, the reinsurer takes on a portion of both premiums and losses. Question 29. What is the key difference between facultative and treaty reinsurance? A. Facultative reinsurance automatically covers entire portfolios, while treaty reinsurance covers individual risks. B. Treaty reinsurance is negotiated on a case-by-case basis, while facultative reinsurance covers all risks under an agreement. C. Facultative reinsurance is used for specific, individual risks, while treaty reinsurance covers a portfolio of risks. D. Treaty reinsurance is purchased to individual large risks, while facultative reinsurance covers smaller, frequent claims. Answer C. Facultative reinsurance is used for specific, individual risks, while treaty reinsurance covers a portfolio of risks. Explanation: facultative reinsurance is used for individual risks where each risk is individually assessed and negotiated. In contrast, treaty reinsurance covers a portfolio of risks under a single contract, often automatically covering all eligible risks within the terms of the treaty. Option A is incorrect because facultative reinsurance covers individual risks, not portfolios. Option B is incorrect as treaty reinsurance is not negotiated on a case-by-case basis, but rather for a group of risks. Option D is incorrect because facultative reinsurance is for individual risks, not smaller claims. Question 30. Which of the following best describes retrocession in the context of reinsurance? A. A reinsurer transferring part of its assumed risk to another reinsurer. B. An insurer ceding a portion of its risks to a primary reinsurer. C. A process where insurers negotiate premiums and commissions for reinsurance. D. A specific type of proportional reinsurance arrangement. Answer A. A reinsurer transferring part of its assumed risk to another reinsurer. Explanation: retrocession occurs when a reinsurer transfers part of its assumed risk to another reinsurer, effectively passing some of the risk it has taken on. This helps the reinsurer manage its risk exposure. Option B is incorrect because retrocession involves reinsurers, not insurers. Option C is incorrect as retrocession does not directly involve negotiating premiums and commissions. Option D is incorrect because retrocession is a process, not a specific reinsurance arrangement.